Santiago, welcome to Validated.
Thanks, Austin.
I've been wanting to have you on for a while. I wanted to talk a bunch about inversion. I think the thesis that you have for that's pretty interesting. But you also have a lot of, I would say, contrarian takes on market, store of value, where things are headed, what actually makes a digital asset valuable or unvaluable, should we say. I want to start off with a little bit, though, on what is inversion? How do you think about this as the angle? There's a lot of different takes on VC and PE in the crypto space, but I think you have one that's pretty different from most other folks.
Yeah, what's interesting is I think you left the Solana Foundation similarly at the same time that I decided to start Inversion. That was last year. You're probably thinking about this over the last 4 years of observing all the build out. And I think, so I decided to start Inversion last year with this idea in mind that there's been over 100 billion invested in infrastructure, almost zero in the deployment of it. And, it's normal in the arc of if you go and study Carlota Perez, technological revolutions. We've been a decade plus into this journey. But I do fundamentally think that we can compress the timeline by which we deploy this technology. And Inversion exists for that simple reason, which is we want to deploy this technology and we want to do it in a way that is very different than how it has historically happened in crypto, which is you onboard users through exchanges and the first thing they see is a perpetual long product on Fartcoin. We're never going to get to 1 billion users doing that because the casino churn is high and people get liquidated. And it's there's a lot of, attention. The ability to capture attention is high with incentive design, tokenomics, and whatnot. The ability to retain the user and serve them other products is limited because when people go to Las Vegas over the weekend, they're looking to do one very specific thing in mind. And so you can't really do much more beyond that. And you see that very vividly on chain. The thing I'll point out to, which I keep coming back to, is there's only 40 million active users in crypto today.
Yeah.
ChatGPT has 800 million. And I do think that we can get over 1 billion users on chain over the next 4 or 5 years. So Inversion is a private equity style deployment where we buy controlling stakes in companies where we think that we can retrofit them with this technology, make them vastly more efficient, and then activate those users. The infrastructure is invisible, though.
Yeah.
And it always is. That is the end state.
So where have you found those types of companies? Are we talking about generally a 3 to 4% margin business that you're taking to a 6 to 7% with crypto, and therefore it's doubling profits? Or are these things that are highly regulated industries, or is this high margin stuff where anything you add to it is just incremental value? How do you think of a good target?
It's definitely the former. There are a couple of key properties of businesses that we like. One is they have a lot of systemic friction. Meaning they're doing a lot of payment flow. A lot of times it's cross-border. So that really shows up in the P&L and the cash flow statement in the sense of they're paying 2 to 4% on payment processing. Then they have a chargeback risk that can be anywhere from 5 to 10% of revenue. And then they do the settlement, which is T plus 7, 10, 15. And that has a material drag on working capital. If a business has less than 10% margin, operating margin, every 100 basis points, every percentage point that you can improve in that business is material.
Yeah.
And the last dimension by which we observe the world is, there's 2 other dimensions. One, what is the level of effort for us to actually implement this change? Of course, private equity becomes useful because when you have a controlling stake in a business, it's easier to drive that implementation. But there's just some businesses that inherently require a lot of things to happen, whereas others that the implementation is more straightforward. The level of effort and the time. And the last dimension is price. And price really dictates the return that you get. And so unfortunately, we're looking at SMBs, we're looking at businesses that are deeply unsexy, have kind of been left for dead. And I can give you one specific example that is not something we do, but businesses that haven't really grown as much, have a lot of connectivity, distribution, and trust in the way of a brand. But the market just doesn't like them because they're not your high-flying AI company or neobank. that you would be paying 20, 30, 40, 50 times earnings or whatever, or more if they're profitable. So that's like the how we view the world. And then we start drilling down into specific sectors, and we have sector-specific theses. Like
a boba guys or something like that?
So there's also a whole set of businesses that we would never buy. From first principles, I never want to assume that I'm changing consumer behavior. So even though you have applications like Blackbird that, people can go to a restaurant and pay with the app, the reality is most people still want to use their credit card. They have a lot of loyalty to their credit card. So like pretending to change massive percentage of the user that walks into a restaurant and pay with a stablecoin is not something that we want to do, because it violates the property that we talked about, which is the level of effort required to make that change is totally independent from what you can do. You can throw all these crazy incentives to consumers in the way of discounts, but it's outside of our control. We like businesses where on the back end, we can change that flow. So we were looking at, I'll give you two examples. One is a business that has a very distributed workforce, kind of mechanical Turk. They're doing AI, like data labeling. And so they have workers all over the world. They're paying them reasonably small sums of money. If you're interacting with a traditional financial system, that has a very material cost to the business when it's sending the paycheck. Enter stablecoins and the ability to transition that workflow to paying those workers with a stablecoin. You can implement that change because if you're the worker, you buy the business. As of tomorrow, every employee in this company will be receiving their paycheck with a stablecoin. Here's the guide. Here's how you do it. There's no convincing there, right?
Right.
And you cut, a very significant part of the cost structure of that business.
Interesting.
And the employee likes it, right? Because they can get paid more in real time, and they can get their money faster, and they can save in dollars.
Yeah, it's kind of interesting because it's not that dissimilar from like the early software expansion systems. Like very famously, I think it was Walmart was one of the first to like actually have a computer inventory system across all of their stores. And they were able, there were lots of people trying to do this, but they were able to do it because they own the stores and they could just set the policy. And so it's interesting to look at like crypto as one of those few technologies where most of the adoption to date has come from the consumer side. Like the only other thing I can think of in recent memory that's similar to that is like Slack, where like Slack was not like a corporate imposed top down system. Like employees basically signed up for Slack accounts, and then the company was like, man, I guess we should corporatize this platform. But it's kind of interesting that like for most of crypto's history, it's gone the opposite direction of most technology, which is it started off in consumer and now is moving into enterprise as opposed to starting off in enterprise and eventually getting down to consumer. What do you think the barriers have been that made it both arrive in enterprise much later? Because enterprise blockchains has been like a thing someone sometimes quite credible, like IBM, has been selling since 2016. Why is there still a market for you to even come in and do this?
Well, there's a couple of reasons. Regulatory has been a key blocker. Mm-hmm. So obviously it started Inversion last year when the Trump administration signaled that they would just regulate this and create clear, visible guidelines for. And that has been a huge blocker for enterprises. Even in my days at Parify, even before that, just talking to businesses, it's just unviable to implement this strategy. You invite regulatory scrutiny. It's just not, the Genius Act is not there. And so any implementation that touches stablecoins, it's one of those things where you're never going to get fired by using IBM or GE.
Sure.
Similar dynamic. Combined with, so the regulatory piece has been a huge blocker. The technology has also been a blocker. I think high throughput blockchains have come a long way over the last couple of years. You know this probably better than anyone. And so, 4 years ago, you weren't in a state of the world where you had enough validity and proof points to say, yeah, we can onboard 1 billion users on chain. And by the way, I might look back and say, God, I was grossly miscalculating. And the reality is, as we brought in more and more users on chain, fees spiked, and there was a lot of congestion, and there was, not as much. So again, it doesn't scare me, candidly. I think when you look at Solana as a system and its ability to process spikes of activity when President Trump launches a meme coin, people might look at that and say, is this really the best thing you can do with the technology? But it's not too dissimilar from how poor and advanced video compression
Yep.
You quite literally built a system that can onboard, shy of 1 million users on a Friday night with low liquidity and process a massive amount of activity over the weekend. That's very impressive. Very, very impressive. And then you start wondering, okay, if you onboard businesses, and we increasingly will want to buy larger and larger businesses, can you actually onboard 1 billion users plus?
Right.
And I think we think of what's the on-chain blueprint or footprint of a user that we acquire. I think meme coins are the footprint of a degenerate gambler is high when the economy is well. They come in, they get the paycheck, they punt.
Yep.
And like every system, you kind of solve them for a peak load, right? Like it's like the spikes in activity is what kills you. And you have to build a system that's just very resilient around that. And so I think there will be sequential ways of capital, like investment in the underlying infrastructure to support more and more users. You saw that with cellular towers, like 1G, 2G, 3G, like 5G LTE. You've had to have the smartphone come along and just the form, like it wasn't really until the smartphone version 3, I think, where you had really good apps. But the form factor is such a killer bundling device.
Yeah.
Such an intuitive device. And I don't think we have that yet in crypto, by the way. I think it is stablecoins. It just has not been presented in the right format to the user, because while you are seeing an increase in activity with stablecoins on the B2B side and payments, companies like SpaceX, companies like Stripe, that category of stablecoin growth is growing in an interesting clip. But a lot of the stablecoin activity is just, algorithmic trading and trading in and out of crypto pairs.
Right.
All this to say, I think the reasons why we haven't really gotten that much adoption can be very single-handedly pointed out to the regulatory piece and the way that we've gone about selling this technology. When every user gets onboarded through an exchange, it is very difficult to try to get adoption for other type of products. And I saw that firsthand investing in all these startups. It's normal. 20, 30% of all of your venture portfolio is going to go to zero. In every conversation that I've had with a founder, it's like, what went wrong? And they said, there wasn't enough users caring about this technology. And it's not that UI UX was terrible. You could argue UI UX has come a really long way on par with Web 2. It's just that when you haven't grown the active user base in crypto beyond this 40 million number, it's really hard to sustain, $1.5 trillion industry excluding Bitcoin. It's just really hard.
Yeah. So I'm curious about this. When you are thinking about bringing a blockchain technology into one of these businesses that you've acquired or you're thinking of acquiring, this is probably the most bag-aligned question I could possibly ask, but how do you pick the chain? Like, what is your internal philosophy or approach to saying, like, we could use Solana for this, we could use some Ethereum stuff for this, we could use some Aptos stuff for this? Like, how much does that... Because it's very easy to say, like, oh, we're just going to bring crypto into our internal operations. That's like, that's like the CEO statement. And there's a whole bunch of people downstream that are like, okay, but like, what's our embedded wallet provider? What's our technology stack? Like, how have you thought through those? And has that also changed over the course of the last year?
Excellent question. We are deploying our own chain, an Avalanche L1.
Interesting.
The reason being, there's two very specific reasons for that. We want to own the execution environment, the execution layer. We think that Avalanche provides an out-of-the-box solution that is good enough. And then we will have a middle layer of applications, stablecoin providers, DeFi protocols, deepen protocols that are either natively deployed in the EVM compatible chain, or we will be we will be connecting to them. So, we went far looking at a business, a telco business, and we wanted to use Helium to cut costs for that type of business. And Helium is deployed in the US, deployed in Mexico. And we said, okay, called Layer 0 guys, said, hey, can I use, as the chain stands, it's an Avalanche L1, Helium exists in Solana, can we interact with Helium? And so I'm not technical enough to tell you that. So I was an investor in Layer 0, called Brian and Max, say, guys, can we do this? And they said, absolutely, we can. And so I think this is interoperability, to your earlier question, has come a long way. And I think over time, that's the state of the world that we'll be seeing, which is there is a place in the world for multiple chains, Solana, Ethereum, all the different L2s. I think that kind of general topology is going to probably exist. Maybe there's some kind of concentration in a few chains, but interoperability has come a long way. And I think we will be interacting with protocols that are not natively deployed in our chain, like Helium, or some of the host of deepened projects that exist in Solana and other ecosystems. The way I see the world is the user should never notice the difference when they're using a crypto-enabled application. And that's sort of the threshold that I have, which is if you're going to replace infrastructure and provide connectivity with Helium to the end user of your telco company, can they stream that video? Can they connect? Can they, is the call going to drop? Is their coverage going to drop? And that's how we see the world, right? And the minute that doesn't happen, we'll just resort back to Web 2 and toggle between these services. So that's how we see the world, right? We want to own the user aggregation layer, which is the portfolio companies that we own, and then we'll point that flow to our chain.
Yeah.
Right now, we are having a lot of conversations with all the different providers in the middleware, like from infrastructure providers, wallet providers, stablecoin issuers, DeFi and deepened projects. But it really starts from this idea of owning the ends of the stack. It's like the inversion sandwich.
It's interesting because there's two things this reminds me of. The first is like very similar to like what D.E. Shaw was doing in like the 80s, where it was like, we buy businesses, but we also have like a ton of this newfangled profession called computer programmers on staff that would go in and like build out software solutions for some of these things they were acquiring. The other thing that's kind of interesting is like this may be one of those classic like money just solves all problems situation where it's like, oh, the easy way to onboard folks is just to buy the businesses and force them to onboard. Which is kind of interesting. I sort of wonder, like, we are operating in a maybe not historically high, but locally high interest rate environment. How does that impact your thoughts on, like, if you're operating in like a 10 basis point cost of capital environment, the things you can look at acquiring are probably very different than a 3.5% to 4% environment.
That's the opportunity that we see, which is private equity as an asset class is going through a tough time.
Yeah, they all IPO'd and then it all sort of fell apart.
Well, the average PE fund as an asset class only delivers like 200 to 300 basis points above the market, like the S&P.
And risk adjusted, that's a hard
exactly.
Bill. Yeah.
And so a lot of the value creation historically has been put a bunch of debt on a business, and then pay down the debt with cash flow, fire a bunch of people, drive some operational efficiencies, do a roll up. Some private equity funds do it better than others. I think some of the most successful ones have adopted technology as a key element in their toolkit to drive value. And you're seeing now that with AI. There's companies that are looking to buy, again, historically businesses, whether you're family owned or principal operated, not agent operated, they've been slow to adopt technology. So technology comes in, you can cut costs. Yeah. But the vast majority of private equity firms find themselves in a difficult position because if you only relied on financial engineering, then you're not going to deliver as much returns. Now, in the businesses that we look to acquire, we are disciplined on price. So say we'll buy a business and we'll put very little debt on it.
Yeah.
In fact, there are businesses where we wouldn't even introduce any debt initially because that could be a distraction, right? When we want to just get a hold of a business that we think is stable, has good connectivity and trust. Emphasis on trust, because we buy trust of a business, and the way I view the world is through unit economics. So if you're buying a fintech company, we were looking at a payroll loan processor. What's the customer acquisition? What's the CAC for that? If we're buying the business for 100 million and it has, X user base, hey, the CAC is $10. And then you look at 10 other companies that are trying to compete in the space and their CAC is 20, 30, 40, 5, 6, 7 times that.
Yeah.
My position is building distribution is incredibly hard, expensive, and time consuming. I'd rather acquire distribution and trust at the right price. So yeah, we don't depend on debt as value creation. We just are simply here saying, look, this technology can allow you to cut costs and upsell the user base of a business financial services in the way of a stablecoin. And the LTV grows, the CAC probably goes down as well. And that alone is enough to deliver 5, 6, 7 times your money if you do it well.
There's this thing I keep thinking of, which is like distribution. I go back and forth on how valuable distribution is depending on different market structures, because distribution is really valuable in a bull market. And then it feels like in a bear market, maybe distribution is a little different in terms of adoption. We're speaking a few days after Monad did what is now considered a pretty successful token sale and a launch. But it's interesting, for a while, like there was this idea of like, oh, did they make a really big mistake by limiting their distribution to just the Coinbase audience? Because Coinbase, big in the United States, pretty small in Asia, like no one in Europe was allowed to participate. And so I kind of go back and forth on, is distribution really king, or is it something more like the product that is being built? And I guess like, it sounds like with most of, let me actually just let you react to that.
So there's a great saying, which is first-time founders focus on product, second-time founders focus on distribution. The counter argument to that is, if you don't have a good product, you're never going to build distribution.
Sure.
So we'll give you an example, right? Because you can always retrofit, by the way, like you can always find an example to fit whatever kind of simple framework you have.
Yes.
You find yourselves in places where you buy distribution and you upsell that user base a product. And, if you don't have attention, ultimately everything, in the first camp, it says distribution is more important than the product. You can distill it down to something that we've seen time and time again in crypto, which is attention is the most important thing. If you can capture attention, whether you're EOS or Cardano or Ripple or meme coins, you're successful. Yep. The ability to capture attention is increasingly harder in a world where we're uber connected 24/7, 365. And good storytellers, whether it's MicroSailor or Dogecoin or anywhere there, or even ChatGPT.
Yeah.
Maybe put ChatGPT aside. But there's a whole category of crypto that is purely attention driven and mimetic. But however, I think you can take the other position, which says without a good product, you can't build distribution. And especially as the world becomes hyper competitive, good products can capture a lot of attention. ChatGPT was able to be probably the fastest scaling product in consumer history. It has 100 million users. Why is it that we haven't seen that type of phenomenon in crypto? And I would argue there's a couple of reasons, but ChatGPT is just so native because it reminds you of Google search. And everyone in the world kind of knows how to do that and just delivered a form factor that doesn't require people to change their habits. Simply say, this delivers actually a vastly more useful marginal experience to my search workflow. I don't think you can be successful totally discarding product and taking sort of the very extreme view that distribution is the most important thing. I think you need to constantly think about both and how the interplay between the two of them. But I will say, as it relates to crypto and how we think about the world, it is incredibly frustrating that as an industry, we haven't really focused on distribution and likely product too. Like, people in crypto play short-term games, and the value extraction, I mean, Austin, you know this, but the MEV attached to meme coin trading is incredibly high. I mean, Binance and exchanges are incredibly profitable. So they're going to take a short-term approach to how to monetize that user base that I would argue is okay, and you can build a fantastic business out of it. But again, going back to unit economics, like what's the LTV of the user? What's the retention profile of that user?
Yeah.
Coinbase versus Robinhood. Which would you rather own over a 5 to 10 year period?
Right. The answer, I don't know. My answer is Robinhood. I don't know about yours.
Robinhood. Absolutely. Yeah. Because they have their funnel is just wider because they're acquiring users probably more efficiently in the way of you have people that are interested in stocks and then crypto, and now they have a credit card, and now they're becoming a full-fledged financial vertically integrated institution.
Yep.
Versus Coinbase, very narrow, only crypto. And it might be incredibly profitable and successful during a specific time of the bull market, but go look at the volatility of earnings between Coinbase and Robinhood in the last cycle. And I was looking at this when Kraken was raising their round earlier this year that I ended up passing on. But it's very different.
Yeah.
Very different.
It's interesting because you go back 2.5 to 3 years, and I think I at least would have picked the opposite. I would have thought Robinhood's on its back feet. It's really struggling as a product, as a business. They force liquidated a bunch of people in crypto. Like they kind of like they sort of paper handed a lot of regulation at that moment, and plus the GameStop situations they ran. But they've come out of it very strong. It's a real testament to the engineering team and the product team over there. Whereas like in some ways you look at Coinbase and you're like, these guys were in pole position. They make a ton of money off base sequencer fees. That's like, I think one of the highest revenue. It's definitely the highest profit margin lines they've got.
And Circle. Yeah.
And Circle, right, which is also non-durable revenue. Yes.
Right. Yeah.
Yeah.
So let's play a game like over the next 10 years. So crypto as a piece of technology is here to stay.
Yeah.
I think the form factor changes. Like it's almost like you're sitting in early 2000s and saying, what is the internet going to be useful for? And no one really predicted that we would have this device that it's an extension of your body and you do everything. So it's really hard to predict, but I do think stablecoins as a core primitive kind of deliver that email moment for the industry, which is it's just a better way to move money.
Yeah.
And by the way, you're already seeing Stripe and Visa and MasterCard and large financial institutions like JP Morgan realize, hey, maybe, just maybe, the financial system should be open 24/7, 365 and not operate on a 9 to 5 Monday through Friday schedule. Particularly if you want to do FX or settlement, and maybe, just maybe, it'd be better if you could settle atomically, instantly, and in a transparent system where you can assess risk in real time and counterparty risk. And maybe we still need to figure out privacy, but it feels like this is a system that is pretty battle tested, regulated, and purpose built for the digital age.
Yeah.
Who captures more value? Crypto native companies, whether it be Ethereum or Solana or Aptos, kind of the infrastructure. Obviously, you guys play a part in that. Middleware providers like DeFi protocols, stablecoin issuers, deepen protocols, or the companies like JP Morgan or BlackRock or MasterCard or Robinhood or Revolut. Yeah. Like, who captures more value? And by the way, you can run the same exercise with AI. By the way, would you rather invest in a hyperscaler or would you rather have $100 million bucket of venture in AI or go just invest in the S&P that's going to reap the benefits of this technology?
Yeah, it's kind of interesting because I think I'll get to your question in a second, but I think one of the things I think about routinely are stablecoins truly a new paradigm that's gonna, all the things you've said, or are they like the best version of a steam engine? And there's a diesel electric sitting on the track next to it, and it only has 1/3 of the horsepower, and it's got all these other problems. But like, you look at that and you're like, is this the last best implementation of nationalized fiat currency? And like, it is gonna still remain powerful, but like, this is peak fiat, right? Are stablecoins peak fiat or not? And for what it's worth, like my natural dissuasion is that the U.S. government will continue existing. The U.S. dollar will continue to be the reserve currency of the world. But that's a very common linear bet, right? It's like that's like a Lindy bet on like fiat will continue to be the thing. And if you kind of look over time, like the invention of the joint stock corporation, like it changed everything overnight. Like there's these moments where like a new economic paradigm comes in and like it changes very quickly. And so part of me keeps thinking like, what would actually, to your point, what would be more valuable, like the US dollar or OpenAI coin? And there is sort of this question at some point of like, are we going to hit a tipping point where many of these tech companies are already bigger than most countries' GDPs? And like the US is sure it's the last Horcrux. But it's an interesting one to think about like some sort of like OPEC style AI coalition able to actually, push the economic, powered by blockchain in some level, can push the economic power of the US around in China. It gets interesting pretty quickly.
Yeah, it's sort of like there's conflicting views in my brain, which is one, technology comes in and totally transforms. Like the most powerful technology, to your point, around the steam engine, the limited liability corporation, the printing press, language, airplanes, the most powerful technology allows us to coordinate better as species. Fundamentally, why I think crypto as an economic primitive, as a coordination piece of technology is more impactful than AI. It enhances what you can do with a lot of other things like the internet and AI. It just is a system that allows us through crypto economic primitives to coordinate better as species, create systems that don't rely on trust.
Yeah.
However, there are things that never change. And Morgan Housel has a great book, which is just certain things never change. Consumer behavior doesn't change. Human psychology doesn't change. The role of governments, I think, does not change in the narrow scope of, while coordination can be improved for economic financial systems, you still need a body of government or mercenaries that can provide and solve for the fallacy, like the tragedy of the commons. You need to have someone that intervenes and provides security and regulates common areas. But security is the most important. And you can't really solve that in the digital context. Now, wars are economic in nature. Like, you win a war if you are well capitalized. You could argue that a technology company might come around and be very well more capitalized. Like, hypothetically, if Amazon wanted to spin up a group of mercenaries and work with Palantir, it could probably defeat like half of the world or most of the world and colonize it. I don't think there's any reason why they'd want to do that, because they sort of play a regulatory arbitrage game. They'll just go to the lowest tax jurisdiction, and they'd rather sell to governments. And I just don't think there's a world where fiat goes away for that specific reason, because the role of the government is always going to be there. The last point I'll say is so Montesquieu created this really good framework of the checks and balances within governments and how to create a good political system, which is, there's three branches: legislative, executive, and judicial. The U.S. continues to be the best place in the world because even though you don't align with your mayor of choice or your president of choice, there's always the judicial system. And the crypto industry kind of learned this the difficult way, but you kind of said, okay, even though there was not due process and I got debanked, I could always go to the courts, and the courts saved this industry. And so I look at that and I say, yeah, the U.S. is and continues to be the best place in the world to operate and launch a business. So the dollar has a place in the world for that reason, and you will respect the dollar. Now, crypto, I grew up in Mexico. You don't have as much guarantees around those three bodies of government. The president carries a disproportionate share to change the judicial and the constitution. You saw this in Venezuela. You saw this all across Latin America. You see this in Asia. So if you can change
the Mexican Supreme Court.
Exactly. I was looking at a telco deal here. The president disbanded the federal communications body. So, okay, well, there's no regulatory approval. So, okay, great. So it's not a good system. Having a non-sovereign store of value like Bitcoin is a fourth, invisible but very strong fourth of stool of that equation, where it keeps governments become more like corporations, where you can pick up your stuff and go to another company. You haven't been able to do that necessarily because as species, we want to move, but we've created these artificial boundaries that have limited immigration. Birds constantly migrate. Now, humans, we can adapt. We have technology that we can survive in extreme conditions. We don't have to migrate from the northern to the southern hemisphere. But there's a natural tendency to be more fluid. Governments have limited that. Capital flight has not been possible. When you have a non-sovereign store of value like Bitcoin, when you can save in dollars,
It gets very interesting. One of the things I think a lot about is that the greatest force for your Amazon example is interesting because it's why would Amazon not colonize, a third world country and do max extract on resources? And the answer is quite simply capitalism does not reward them for that. The actual highest plus EV thing they can do is sell to everybody, not own everybody. It's a very interesting structure where I think a lot of the global stability that we've seen, even in the world nowadays, we don't think of it as a particularly stable system, but compared to 1984, it's incredibly stable. Where you had, hundreds of thousands of nukes ready to go at a moment's notice. It's interesting because this is kind of the piece that like I've been reading this this book, Wages of Destruction, which was a Joe Weisenthal recommendation, but it's basically all in the interwar German economy and how the lack of free trade really pushed that country into a position where its options were basically to give up or to wage war. And we all know, unfortunately, how that one went. But it's a very interesting comparison here because like this feels like we're getting into a world where like free trade is crumbling, international cooperation is reducing. At the same time, as you're saying, we do have this fourth leg of crypto and Bitcoin and non-sovereign store of values, which could be an interesting force for global cohesion and actually have a similar force for peace the same way free trade is a force for peace. That's what keeps me hopeful these days, at least. I do want to kind of get back a little bit to some of what we were talking about before around like the how you sort of view crypto being able to change how companies operate. And so I'm wondering the sort of thesis you've been talking about how like, crypto is a threat to governments. Do you think it has the same effect at some point on corporations? Like, are we going to see this sort of like very hierarchical corporate structure in some ways erode? I mean, we've seen this a little bit in even like HFT firms where they're losing some of their best people to the idea of like, I can go build a project in crypto. There's more and more folks that are like, maybe I don't need to go to college. Maybe I'm, in rural Iowa or, somewhere in the poorer part of Asia, and I don't actually need to do the traditional route.
Again, like two different views, seemingly conflicting views in my brain. One is technology has collapsed and removed barriers to education. And so I think you'll continue to see more and more people just train themselves, and the access to knowledge and information has never been at a greater point in time. And your ability to access that with something like ChatGPT, like, you could access it for free. I grew up in a world where you had to update your Encarta 8 discs every year, or your Encyclopedia Britannica that was very expensive, and your access to public libraries. So that's just not crypto related. Another part of me says the humans don't change. They want to be spoon fed. It's the structure that a 4-year curriculum gives you will always serve a place for a specific group of people. Now, I think you could argue the value of an MBA has gone to zero. The value of a college education can only go to zero if corporations start hiring people without the titles. And I guess like, what is that title? But so again, I'm at a holistic level, like the way I think about investing is there's a pocket of the market that is so techno optimist and says technology is going to come in and change everything. I would say I'll qualify that by saying it will change a lot. And most of that is like rapidly declining costs across most things. Yeah. And that creates more competition. That pushes asset prices to an extreme at some point. And then there's a part of the market that is totally overlooked. And the market discounts certain pieces of distribution and trust and brand that is harder to chip away at, I would say. And as your role as an investor is certainly to have a view on the impact of technology in traditional legacy industries and businesses. You don't want to be caught in the wrong trade of being super long in newspapers and classified ads, or super long, the price of, I don't know, what's a good example? Like the price of like LASIK surgery has gone dramatically down because it just became more competitive because like they're private practices. Like imagine if you took the other side of the bet, you would have gotten crushed. So like as a whole, like, you could be sitting there in 1990 and the vast majority of the S&P index was like industrials. And then now it's the vast majority of it is just technology companies. This creative destruction element is something that is harder as an investor now because the turnover, I think there's like a couple of things that investors like grossly overstate. First mover advantages are not as real as most people want them to say. Network effects is a common term that gets thrown around. It is not properly understood or quantified. And people look at and try to fit analogies of how Facebook and social media networks like totally captured value and are applying that to crypto and are totally off the mark, in my opinion. And we can go into that. But again, as I think about inversion, I'm super long this technology. I think the thing that benefits the most is the ability to cut costs in ways that were never possible before, because you have had systemic friction of antiquated systems that predate the internet. And that's all I'm trying to do. I'll reap the benefits of lower and lower technology costs, whether it's settlement costs have dramatically come down. Like, we're no longer in a state of the world where it costs $1,000 during peak season, NFT season, to settle a transaction.
Yep.
Who benefits the most in that equation? My end user. That improves my relationship with Serve, a core use case, stablecoin oriented, for a user base that has never been able to save in dollars and earn yield.
Why do you think tokenized stocks haven't taken off? Like, this is the thesis, was like, for years, I have my own views on this, but like, for years, it's like, you know what? There's like a whole army of folks in like Pakistan and Jordan and, you know, pick your country that is boxed out from traditional market access, or, you know, oh, you can only buy Tesla in, you know, Colombia if you have $500,000 in your account to get access through a brokerage. These things are functionally accessible at functionally parity with prices on Robinhood on chain now, and the volumes are functionally zero. Like, do you think that thesis was wrong? We're too early. The market doesn't know these things exist. Like, why are people boxed out, who have been boxed out of these markets, not flocking to these products?
That's an excellent question. Would you say that so you have, on the left side, you can punt Tesla stock. On the right side, you can punt Fartcoin.
Yeah.
The user base that exists in crypto, which one are they going to pick? And do they have access to Tesla and outside of this world, outside of this digital casino?
Right. And so for US people, right, obviously we have access to all of them. But it's like, in the US, yeah. But if you're like in Eastern Europe, like, it's not super easy for you to buy exposure to US equities.
Correct. And that would have been the thesis behind tokenized stocks, which is, let's open up the US stock market to the rest of the world. And it's very interesting. I too would have thought that there would be more demand, and sometimes things take a little bit longer to take off. I haven't looked as closely. I think there were a couple of implementations of it, but the liquidity and the spreads, and maybe they're tight now, but there have been moments where they haven't. It does make you wonder, like, who is that user base in crypto today, and what exactly are they looking for? And are they always going to be just more interested in going out farther out on the risk spectrum on some of these token asset prices? Whereas Tesla no longer is exciting. You'd rather take a levered bet on Tesla by investing in Monad or some of the robotic companies. You know, it's sort of interesting. Like, you have, anytime Tesla stock runs up, or there's like some sort of tweet on Elon on robotics, or there's like a big round in the private markets on robotics, you see some of the robotic like tokens that I don't know exactly what they do, candidly, but you know, it takes off. It's like an index.
Yeah.
And it's more liquid.
Yeah, it's always been interesting because, like, yeah, I have two views on this, right? The first is like, oh, this is a market education problem. Like, you go back like 30 years and less than half of US households had any direct or indirect exposure to the US stock market. And today it's like 75%. We've had this massive increase in people who actually own stocks just in the last 30 years. Is this the case where the developing world just literally doesn't know that, like, over time, the best thing you can do is buy an index fund and, like, you know, maybe pick a few stocks, but like, this is actually your place to getting out of your wealth trap? Or is it very similar to what happened in telecom in the developing world, where like they just skipped landlines, right? It went from zero connectivity to cell phones, and we never bothered running the hard lines except in a few sort of places. And is that's pretty much what's happening, is like they're just skipping equities and going straight to meme coins?
Yeah, I mean, this goes, I think I agree with that. I think you're in a state of the market where people are psychologically are more connected, and they want to leapfrog into generational wealth. Markets are not patient, they're momentum driven, and you're going to rotate into what you think is the quickest way to secure the bag so that you can go on a vacation to Europe and afford the. But you have contrasted that with an affordability crisis. Like rates are still high, and the average consumer is really not in a good spot. And naturally, that just creates a more proclivity to go out and farther out in the risk spectrum, because whether it's a biotech stock or AI or fart coin or meme coins, it's very momentum driven. I would say a lot of the price action recently is just crypto's kind of no longer the main character. It's AI.
Yeah.
And so, are you, and the market's impatient, right? Bitcoin's now erased all of its gains, and a lot of the alts have just come down, and there's no limited liquidity. It's sort of the best time to build. It doesn't derail the thesis, but yeah, markets are just incredibly short-term driven and momentum driven. And I don't know, like a lot of times what happens in crypto is because it's hyper financialized, and there's always a price behind a thesis. It's almost like there's a constant poly market before poly market would have told you, there's not enough volume on tokenized stocks. Totally discard them. They're useless. And I think it pays to revisit the thesis constantly and then understand, is it a product problem or is it a distribution problem? Because I think distribution takes longer to build, and the education is harder and harder. I think about poly market, where I was an early investor. You saw this, and then that.
Yeah.
Just a huge inflection. And it was because the presidential election comes along, and there's a contested the first Trump election happens, and the result is contested, and poly market sits at the center of that. And you had a president talk about it. Was that a product problem? It had been around for a while. Or was it a distribution awareness problem? I think it would have been an awareness problem then and there, had they not spent the last years building, had you not had stablecoins to be able to settle that bet in a stable unit of account, not Ethereum or Solana volatile asset. You could have had Polymarket there, but it's sort of a chicken and egg thing. And so I think it's both product and distribution as it relates to tokenized stocks. I think the product is not in its final form by any stretch of the imagination. I think there's still some nuances that need to be figured out around, like, how do you manage liquidity in ARB when markets close, but tokenized tokenized stocks can be traded over the weekend?
Yeah.
Clearly there's roles for market makers there, and there's an ability to ARB out and make money. And then the distribution, like, is Robinhood going to support it? Which wallets support it? And I think that plays a huge part in that. As a builder, I think all you can say is, I fundamentally still believe there is a huge demand, latent demand there for having exposure to the U.S. equity market outside the U.S. for the vast majority of the world that wants to have access but doesn't. We just need to get it. This is more now of a distribution and awareness problem, in my opinion.
Well, before I let you go today, if you talk to a bunch of founders and entrepreneurs, how are you telling them, or how are you advising them to think about the next 12 months?
Well, be incredibly well capitalized is always the rule of the game. Like, you never want to have a expiring option.
Yeah.
Control your costs. Seriously. Like, there's the recklessness in spend is high when you go in crypto. It's always been high, and it's always bothered me quite a bit. Part of the reason why I don't like going to conferences is because you just see that wasteful spending. And 1 minute you think you have all this money in the world, and another you don't. And, while I am at Inversion very focused on bringing a user that has never existed on chain, that doesn't care about if Bitcoin's at 100 or 84K or 20K. And I think that has spillover effects. Like, if we credibly execute on this, we can onboard double, triple, 10x the active user base on chain. And that will help. If you build a good product, best believe that we're going to route to it and use it. It doesn't matter where you exist. And so just survive to kind of see that end state. Like, this technology will get adopted. We will have over 1 billion users on chain. It will happen in the next 4 years. Continue to build. Make sure you never compromise your ability to build, and build a good product, because good products get discovered. And it's something you can't control. It might be a presidential tweet. It might be the fact that you met someone in an elevator. like I love listening to Founders Podcast because the arc and the evolution of a company is incredibly random sometimes and path dependent. Like it's just a singular moment in time in the history of so many of the greatest companies in the world have been determined by that person decided to take a different route to work or take that last call. Amazon famously kind of raised around like weeks before the stock market collapsed. And had they not done that, like, you know, maybe there would be another Amazon, but you never know. And so like, it never hurts to be well capitalized and just be super, super protective on managing your costs. And you kind of heard it from Naval, like there's only herbology, like as a founder, I don't think you can delegate a few things. They said fundraising, you can't delegate. Recruiting, largely don't want to delegate. Like you want to make sure culturally you're hiring the right people. And I'd add a third there, which is, you know, managing your expenses. Like, yeah, you're hiring a head of finance or whatever.
Yeah.
But learn how and look at your balance, your cost structure, and make sure that you are optimizing for surviving and having a good runway. Because if you don't, then fix that as quickly as possible.
So if folks want to learn more about you, Inversion, where can they find your writing? Where can they learn more about Inversion?
Yeah, we're on X and Inversion_cap, inversioncap.com. We are hiring a bunch of folks, investing roles, product roles, and engineering roles. If you're tired of the casino and want to build something durable, give us a shout. We're hiring. And I'm on X, Santiago Roel.
Excellent.
Great.
Have a nice Thanksgiving.
Thanks, Austin. Happy Thanksgiving.